Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reinick, and this week I'm joined by Zacks Senior Strategist Kevin Cook to discuss one of our favorite topics, the 13F filings. We haven't talked about this in a while. It's been at least a year, I think. We kind of got depressed about it or something. Right. I don't know what. And now this year we've decided to take another look because some interesting things were happening in the first quarter, and it's time to talk about it. So the 13F forms have to be filed by mainly the big money managers 45 days after the end of the quarter, right? That's their deadline?
Yes.
Okay, so that would have been like May 15th of this year. So we've been getting a whole bunch of them in through May 15th, and now we can see what they were doing. So one of the first big announcements, I feel, was that Berkshire Hathaway bought shares of Amazon during the first quarter. Warren Buffett announced that a little bit earlier than their actual filing, because they were having the annual meeting, and I guess he felt like, I need to fully disclose everything. So he announced it. He didn't tell us which of the lieutenants had bought it, because it was not him.
Right. Warren Buffett, the tech investor, didn't buy it?
Yeah, no. He has lamented in the past, though, that he wishes he had bought Amazon a while ago. But he didn't seem to want to talk about this purchase at the annual meeting. He did get some questions. They didn't bring the lieutenants there to answer any questions about why they bought it. He had to kind of justify it to some of the shareholders who were asking about it and saying like, oh, of course, both of them are value investors and, they haven't changed their philosophy. But he didn't really go into how Amazon is a value necessarily by normal value metrics, at least. So we still don't know. We're kind of still in the dark about like why they bought it.
And did he get kind of annoyed that that was the focus?
Yes.
Because, of course, the reporters were all over that.
Yes.
Or was it shareholders asking?
Shareholders were asking at the meeting.
Okay.
Which he knew would happen. That's why he disclosed it. But yeah, he was still basically annoyed by anything having to do with Amazon.
Right.
So it's just kind of sitting out there now. We did find out from the 13F that it was nearly $1 billion purchase. So that sounds big, but that's not that big for Berkshire. So fine, they're in it now. We'll see if they're going to add to that position. They have a big position in Apple already. That's one of their largest positions. So this just adds on to the fangs.
Yeah, you kind of opened with like we haven't talked about this in a while.
Yeah.
It's not as exciting when the market is just steadily grinding higher because fund managers are doing something that's pretty predictable, which is they just keep accumulating.
Yes.
There's the occasional, somebody, started a new position here or somebody liquidated one there. But what makes this more interesting is we had that big market correction in Q4.
Yes.
Where some babies were getting thrown out with the bathwater.
Yeah.
And then we come into Q1 where, I didn't think a trade deal would get done. I never did, but I thought the market was rising on hopes that one would.
Yeah.
And yet you saw investors putting money to work despite any of those fears.
Right.
All right.
Yeah.
Sounded like my audio was going out there a little bit, so I just want to
Some of it was
I'll
crazy.
keep an eye on there.
He's shaking his head.
Okay.
So we're good.
So, and the other thing is like we love the stock market because not just because we love investing, we like learning about companies, across all sectors, especially, exciting things in technology and healthcare or, consumer stuff. And there's exciting stories about all these companies, but there's exciting stories too in the fund managers, right? And we can talk about this two different ways. We could just drill down into one fund manager and tell a dozen stories about the economy and the stock market.
Right.
Or we could pick one stock and go laterally across fund managers and have a bunch of stories to tell that way too. So it's a lot of fun and there's tons to talk about no matter which way you slice it.
Yeah. In prior episodes, I think we focused more on like the managers and kind of what they were doing because people know these names. We know Warren Buffett and Berkshire Hathaway. We know like David Einhorn, David Tepper. Those are the people I looked up again for this podcast. But this time I feel I also drilled down into what some of the stocks and how many managers were adding or reducing or getting a new position with some individual stocks. And I feel like that is a result of the sell-off in Q4, plus the trade worries who was buying some of the stocks that could get impacted, pretty severely in the trade war, and what were they thinking? Although, again, this is all backward looking, so it was through March 31st only that they were, doing these purchases. So, yeah, I feel like I took a little bit different look this time. So
So since you opened with Warren Buffett, can I open with one of my favorite fund managers?
Yes, please do.
David Tepper of Appaloosa.
Okay.
He's got about 12 to 13 billion under management, and what's remarkable is that he's a remarkable fund manager in terms of his steady performance as a growth investor, but that his assets under management are so small. And that's because he tends to return money to his investors once a year.
Okay.
So that and because he likes to stay nimble. He doesn't want a $25 billion fund.
Right. The bigger you get, the more limited your options.
So it was interesting to see both in Q3 of last year, he sold some things so he could buy the Carolina Panthers for $2.2 billion. And then he also shifted some money around and had some tax implications. I remember he sold Alibaba, which is something I owned. By Q4, he was out of it. And what's interesting is he got back in Q1. And I thought, well, wait a second. Is he actively trading Alibaba now, or has the long-term story changed? So maybe it's possible that he was spooked by the correction in Q4 and worries about the trade war or worries about the Chinese economy, which, there's three things right there, right?
Right.
But then he changes his mind. He only bought 700,000 shares.
Well, that was my next question.
Yeah.
How big of a position?
not a huge position, but I think he probably thought it over, and maybe he concluded, okay, trade war could get worse, but here the stock market's going up. Alibaba's, rallied back to, I think over 180. So he probably looked at it like he couldn't stand not being in the name, which is the same way I would feel.
Yeah.
That I wish I had gotten back in it. It got all the way up to 195. So, and he probably thought, oh man, this thing's going to get away from me. So he bought some shares.
Now, don't you feel like the Chinese stocks are a little risky here, though? But obviously, again, this is first quarter through March 31st. So we're a little bit beyond that now.
Again, we're talking about...
And then the trade war heated up since then.
Yes. Yes, it did. And
but these are the pros, so to speak. And so they should have been, factoring in the possibility that it could get worse.
Right. And Tepper is a guy who owns a lot of big cap tech. So he owns Facebook. I noticed that. He owns Amazon. I think he sold Google.
Those two are in his top 5 holdings.
Yeah. So, the way he looks at Baba is, if they are something like the Amazon of China, you have to own them, right?
Yeah.
Because of what they're going to become with a population of 1.3 billion people and, the world's largest middle class, essentially. A middle class that could be, you could call their middle class over 600 million people. You want to own a key player that connects with consumers. So I'm hoping that that's his logic, is like, I just need to own it. We'll get through this. It's a long-term hold kind of thing.
Yeah. Well, we'll see.
Yeah. So
what else does he have?
I want to stay on Tepper because then we get to talk about some other really interesting stories.
Yeah.
We'll come back to a technology name that practically everybody owns.
Okay.
But
we won't.
But first, let's
say what it is yet.
Yeah. First, we'll talk about a debacle, which was Pacific Gas and Electric in California.
Yeah.
So the big fires there. All of a sudden, it turned out that lawsuits could be brought against the company, and if the lawyers had their way, it could conceivably bankrupt the company. So you watched the stock go last fall from $45 to down to $20, kind of stabilized.
And then there were those weird rumors that Warren Buffett was going to back it or something strange.
I never heard those.
Yeah, that was out just a couple of weeks ago, though, and he actually had to release a statement saying, "No, I'm not interested in buying them or putting money in there to backstop them." So yeah, then that went away.
Yeah, it's a really interesting story. I was looking at the holders at the time because a famous value investor, Seth Klarman of Baupost, he owned a big chunk, and then he added when the stock fell. I just want to get a look at the chart from going back so I can see actually what it did when it fell from $45 to 20.
So this is like a almost 12% position of the portfolio in Tepper's portfolio. This is like this is his third largest position. As of the first quarter.
You have it that high as
11.8.
Okay. Yeah, I mean so Tepper added. I just want to recap what happened with this thing in last fall, because Seth Klarman bought a bunch too. It's like I was thinking, oh man, it couldn't wipe him out, but it could. But he owned such a huge chunk, it could have wiped out 10 to 15% of his portfolio if it went bankrupt. And so by the end of December, the stock plummeted below $10. And that's probably when the news was the worst.
Right.
They were talking bankruptcy.
Yeah.
Now it's trading 18, so it had a nice Q1 recovery. But David Tepper bought 16.6 million shares to bring his stake to 23 million shares. So, and I have to believe, and I was asking you this earlier for your legal perspective as a lawyer, it's not like a hedge fund manager can call up the CEO and say, "Hey, I want your assurance you're not going to go bankrupt, before I invest $10 million in your company." And they can't do that.
Right.
But somewhere along the way, there must have been word that California wasn't going to let the thing go, right?
I don't know.
Yeah.
I mean, that's the question.
I mean, because there were some other huge buyers too. There were two other funds who bought between 20 and 25 million shares of PCG, probably anywhere from 10 to $20 during the quarter.
I looked this up. 32 funds created a new position in it in the quarter, and 29 added to an existing one.
Yeah, and the top ones were very big buys, like 25 million, 22 million.
So they were seeing, that the selling was overdone here.
Right.
But you do have the BK
thing
lurking out there.
I gotta believe that somehow somebody got assurances, either from somebody in the state of California, or the company, that they were going to hold this thing together. That it was essentially a too big to fail, right?
Yeah.
I mean, what would California do if they had to? They're instantly going to have to help fund a new energy provider, right? So why not just keep the existing one afloat and somehow hold off the lawsuits from destroying the company? And that obviously brings in the insurers too, right? How much are the insurers going to pay for these lawsuits,
right?
If they either settle out of court or they're found guilty. So the other stock that I teased that is a big David Tepper buy is Micron.
Yeah.
And what's interesting here,
MU, everyone, MU,
yeah. He added over 3 million shares to bring his stake to over 19 million shares, making him the 9th largest holder. Now, this is interesting for a few reasons. First of all, Micron is sort of at the center of the trade war, technology, because Micron makes the memory chips for just about everything.
Yeah.
And for a long time, their business was so cyclical because memory was just a commodity. But now that memory chips are so integral to our smartphones, and then other smart technology, whether it's data centers, artificial intelligence, all this stuff, autonomous cars, that's why Micron's business sort of broke out of being too cyclical, because they had all these different growth areas.
Okay.
They were growing not just in a PC, but in the data center, in the smartphone,
right,
in the autonomous car. And so obviously Tepper's a big believer.
It's 22.8% of his whole portfolio now.
Yeah, now it is. And
don't try this at home, everyone.
Right. What's interesting about him, remember I said how small his fund is, relatively speaking?
Yeah.
Say 12 billion. The 8 largest holders just above him are the mega holder. You're talking, it's
so
Fidelity.
That tells you the size.
Yeah, Fidelity, T. Rowe Price, Capital World Investors.
And they're in it because their ETFs own it.
Exactly. Yeah.
They're not just investing.
Yeah. So for them, they can have a 25 million share position, and it's a small part of their portfolio. It's not 22%.
Right.
Talk about concentration, and Tracy and I have talked about this before, because concentration is a way to win. Warren Buffett doesn't really believe in diversification. He wants to pick companies.
Right. Speaking of him, not only does he have the big position in Apple now, but 40% of Berkshire Hathaway is in banks and financials.
Okay, there's some concentration.
40%.
Wow. Yeah.
Nobody talks about that. That's very concentrated. So yes, a lot of these big investors do the real, but it's do or die then, basically.
Yeah, you better be right.
So another one, let's talk about another really concentrated one is Ackman at Pershing.
Okay.
Because he has his top 3 holdings are like 50% of his portfolio. And his largest holding now is still Chipotle at 19.7% of his whole portfolio. And then he doubled down on the restaurant industry because he's in Restaurant Brands, which is QSR is the ticker there. And they own Burger King, Tim Hortons, and Popeyes now. And that's 17.8%. And then he stays on the consumer side with Lowe's, 13.6% of the portfolio with that one. So that's pretty concentrated, but he's doing quite well, at least on the CMG.
Yeah, I
was happy
to see him get a win there.
Yes.
So according to 13F list that I'm looking at here, which is just from NASDAQ.com, he couldn't be the second largest holder, could he?
In Chipotle?
Yeah.
I don't know. Maybe.
I'm really surprised.
I'm not sure.
I got to double check this.
A lot of people were fleeing it, so for a couple of years.
I'm seeing Vanguard with 2.9 million shares, and I'm seeing Pershing Square with 1.8 million. And BlackRock is behind him at 1.5.
It's not that big of a company, so that would not surprise me.
Now, he actually sold 78,000 shares.
Okay.
So just
he's cashing in a little bit there.
He took off less than 5% for profits. But I remember he was a buyer just above 400.
Yeah.
And everybody was like, what? You're going to buy E. coli? No.
Yeah. Because people were fleeing.
Yeah.
So this was another example of one of the managers.
And I think we talked about it at the time. It's like we have the classic example from the 80s when, was it Tylenol, Johnson & Johnson had to, how do you recover from a disaster where people don't trust your product anymore?
Right.
It's always possible because first of all, time passes and people forget.
Right.
And then if you can sort of, get your brand still out there and show the people that you're consistently doing something right, then people slowly come back, and then you get new generations come back too.
Yeah.
So it's like Tylenol still in our house, that was just a freak thing. It wasn't really their fault.
Right.
This with food, I think people probably found more threatening, and yet look how quickly people forget. Because it could happen anywhere. We eat out all the time,
right.
So why would we trust one restaurant over another?
Yeah. It's been a couple of years hard going, but it does seem like they're putting that behind them. So that's one I watch.
The lines are still out the door at lunchtime.
They are. Yeah. Let's switch to another big investor and see what he's in, David Einhorn at Greenlight.
Okay.
Because his biggest position is an interesting one, I feel. And he's been big in this for a while, but it's General Motors. It's 24% of his whole portfolio.
Wow, another
now.
Huge concentrator.
Yes.
General Motors.
GM, that's recovered off of its recent lows, but still not, you're not getting Chipotle returns there, but you do get the nice dividend. So
and I think he might be at a loss for what to do. At one of his recent investor letters, he had to explain why his performance was so down the past 2 years. And
it's hard looking for the value names for sure.
I know I paid attention a little bit because remember when I shorted Dillard's?
Yes.
DDS. I shorted Dillard's a little bit in Q4, and then I tried again in Q1. And just because I thought, okay, I mean, energy was sort of slumping. We hadn't had the big oil recovery yet. And Dillard's is in most states, but it has a heavy concentration in Texas, Oklahoma. So its fortunes correlate to the energy market, so to speak. But I just saw that their sales were declining, profits were declining, and the trend wasn't reversing. So I thought, well, you can short this at, in the 70s. He was actually a buyer in Q4. And I thought, okay, here the value investor likes Dillard's. He got out of it.
Okay.
He got out of so he
retail's hard.
Yeah.
Other than the Lowe's and the Home Depots.
He finally saw what I saw.
Yes. Apparel is very difficult. Let's take a look at a couple of other just stocks in general, since we're talking about them. So we talked a little bit about Alibaba, but JD.com is in like a similar situation, trade issues, consumer issue in China, but 90 funds added new positions to it in the quarter. So that's kind of interesting. But a lot of the Chinese stocks were beaten down in the fourth quarter. It was really
cheap, yeah.
Yeah. So people saw value in that one, including a name many people will probably remember, Dr. Michael Burry. He was in The Big Short. He was featured in that because he got it right about the mortgage-backed securities, and so he made a killing in that. He does still run his own fund, but it kind of went dormant there for a while, but now it's apparently back, and it's called Scion Asset Management. So he bought JD.com in the quarter, and it's now his biggest position, 9.2%. He also bought Altaba, I guess that's how you pronounce it. AABA is the ticker, and they own 15% of Alibaba.
Right. That was like the Yahoo spun that off.
Yes. And it's that's his second largest position now in the portfolio. So he's going in on a little bit of the China thing there. I'm not sure why he bought that one versus just not buying Alibaba, but they are the second largest outside investor in Alibaba. I think SoftBank has the biggest position. And
I was trying to think of who played Michael Burry in The Big Short. That was Christian Bale, right?
Yes.
Yeah, he played.
Yes, for those of you wondering.
Right. Isn't that the character he played? Because Asperger's, maybe? Did Michael Burry have Asperger's?
I don't know.
Or some spectrum.
I don't know. I think so.
Where obviously he was very good at concentrating on numbers and not so social.
Yes.
But loved to listen to death metal.
He used to write, he used to write like he used to go in the chat rooms and talk about value stocks, which is how he got started as an investor. So don't think you can, you have to have some kind of background. He is an actual medical doctor. So,
right.
Yeah. But he still considers himself to be a value investor. So that's interesting that he's going into some of these Chinese names here.
It is.
Yeah. So that people taking some chances there with the trade war going on. I looked at Baidu. Again, this was before it took another leg down on its recent earnings that these people would, these managers would have been buying or selling in Baidu. But first quarter was still not that great for the stock. It was down 44% for the year going into its earnings report, and then it's tanked further. But 21 new managers added it in the quarter. 38 added to their position, 14 did close it out, and then 32 reduced on Baidu. So that's also one to watch. And then I looked at this interesting company that I just did for a bear of the day today, Stamps.com. And they're not just stamps. I always get this tweeted at me like, who cares about stamps? No wonder it's declining. Like, no, that's not totally
what is it
what
besides
it is.
Postage?
Well, it's online postage though. So think about like all they make the software for it. So think about if you're a small business, you're not like running off to my dad used to have to go to the post office like every day to mail stuff back in the day in like the 80s. And now you just sit in front of your computer, obviously for the last 20 years, you print it off. But like tons of businesses have access to the online
I'm laughing
shipping.
because this is a sore subject for me. As you noticed on Twitter, I tried to send a package.
Yes, I do remember
the U.S.
that.
Postal
yes,
Service.
And they sent it to the wrong city. That's not good.
It went to Milwaukee first, and then it was supposed to go to Plymouth, Massachusetts, and they just sent it to Plymouth, Wisconsin.
Yeah, that's so
and
weird.
I thought, aren't we in the digital age?
Yes,
like, isn't
it's
the
supposed
zip code?
to scan it.
Yeah.
I thought like even the writing doesn't matter. It only scans the zip code.
I was told it was human error.
Wow. So weird. Yeah. So hopefully the software that Stamps.com makes it a little bit clearer for the things that people are shipping through them. But, business was kind of zooming along. The shares like soared in 2018. And so did earnings. I mean, it was like not a super expensive stock by the PE ratio even because the earnings were sticking up there. And then in February, they basically came out on their earnings call and said, well, we've gotten rid of our exclusive contract with the U.S. Postal Service now, which was a huge chunk of their business. So that went away, but they wanted to be able to negotiate with the Amazons, FedEx, UPS on the side instead. That's why they're getting rid of the exclusive. So, but this was going to take some time to get, those clients on board versus just the U.S. Postal Service, and all of this was going on. And so in February, they cut their earnings estimate for the year dramatically because they were losing the exclusivity. Well, then we get to this quarter and whoops, other things are happening that we didn't foresee, including like Amazon, FedEx, and UPS being resellers for the U.S. Postal Service. And they didn't know that, or that's going to impact their negotiations with these other players now. So they cut again. But the shares plunged after the first cut, literally like 50%. And so did hedge fund managers go in there to buy, thinking like, oh, the worst is over now? They've already made this announcement,
I'll
right?
take a look. Did you take a look already?
Yes,
I just want to say, before you tell me who bought, I'm going to tell you who sold short.
Okay.
And that was our own Jeremy running Counter-Strike here.
Okay.
For his active trading portfolio.
Into the next earnings?
Yes.
Okay.
So he
Wow,
so
good for him.
after it fell from 200 to 100, whatever he saw in the charts and probably said fundamentally like, okay, losing the post office, because that's what you said the first drop was about, right?
Yes.
Lost the post office contract.
Right.
Estimates were coming down, so it was a Zacks number 5 rank here because all the analysts had to just like slash. Yeah. And so Jeremy just saw it as a short opportunity, around 100, and so he went into this earnings report, holding on, not looking for the recovery, but taking his chances, and it worked out. So he had like over a 50% winner there.
Wow. Yeah, good for him for seeing what's going on the chart. But it's plunged another, I think something like 50% after this recent earnings now. So
yeah, that's where he made his money on this one.
On this one,
yeah,
okay.
because he got short after the first debacle.
That's right. So that was smart.
Yeah,
but not everybody was thinking that way. They did think that the worst was maybe priced in there because it was a severe drop off after that first announcement.
All right, so who was buying?
Well, it's not any big names that you would know, but 20 did create new positions in the quarter in it after that plunge down, and then 17 added to the existing ones.
Okay.
So all of those basically got caught in now the second warning.
Yeah, they should have listened to Jeremy.
Yes. So it's been pretty brutal, but you can see what may happen in this quarter. We don't know. We won't know for a couple of months still what they're all doing now that it's plunged again. If they're going to add double down, triple down, I guess, on it again and get in there, because the estimates are, severely being slashed again because they did lower. And this is kind of stunning to see with this economy going on, but earnings are expected to decline 67% now year over year, just based on this one kind of quite big event for this company.
Yeah.
But wow. So that's pretty brutal. But another little tidbit from Whale Wisdom, where you can go and find out a lot about what's going on with all of these filings.
I use it all the time because they have an API just like, NASDAQ or whatever.
Yes.
That just... They
grab all the data.
Yeah, the filings just go right into the database.
And it's free. At least the basic version is free. So you can go check it out on Whale Wisdom. But they put out a little tidbit saying that Square was the number one for the quarter on their heat map. And that tracks the top 150 hedge funds and their moves and everything. And 28 funds added Square, which is ticker SQ, in the quarter. And then only 9 closed out. So 28 new positions in it. And that's probably because the stock was down big in Q4, like a lot of the more volatile names were. And now it's up big in Q1. But a lot of the managers, the growth ones, saw real value in getting in there after over 40%.
I bought it near $50
decline.
in Q4.
Yeah.
And we made some money on it. And then I just thought, this thing's going to bust out. It's going to bust above $78. We're off to the races. And no, because there's increasing competition. Did you see?
Definitely.
T-Mobile rolled out GoPoint, which is their, they want to go head to head against Square for small business.
Okay. Do they have a chance? Aren't they behind?
I mean,
they're kind of like a couple years delayed.
Yeah, I was thinking about like, the way things have to catch fire with consumers and small business, it may not. It could be a total flop because people, they loved the Square, they loved the idea, and then once they're in, Square's
you're not going to switch.
Square's building out this whole ecosystem.
Yeah.
You know what Square's doing now? They're letting you set up your own e-commerce page.
Oh.
So instead of going to Shopify or Amazon, if you're already a Square customer, you're going to they're letting you build it for free.
Okay.
So right now,
is T-Mobile is the reason because like I see Square a lot when I'm in like a cab, they'll have it on their phone and then you can pay by credit card, just like, swiping it on their phone with that little thing attached to it. Is that why T-Mobile thinks they're going to be able to, and any small business that would just have a phone capabilities of taking the credit card?
They're also trying to be a little bit disruptive in the sense that they want people to have their money instantly. They want small businesses like, you transact the sale, we're going to give you your money right away. Almost. That's what they're saying. Like, no, you don't have to wait for your money. So that's their pitch right now. We'll see if it works.
Yeah.
But I own a company that is the back end technology for that. Total System Services.
Okay.
They're sort of the behind.
What's that ticker?
TSS. They're sort of they
Total System. That makes sense.
Yeah, they do. They'll be like the credit card back end for somebody.
Yeah.
They're the sort of the white label, whatever the technology. They're behind the scenes. They've been around for a long time. I want to go back to Micron for a second because you're talking about, like, when you talked about Stamps.com, all these funds buying. And you mentioned Square being the number one.
Yeah.
Did you say it was the number one bought?
It was the number one on their heat map.
Yeah.
Yeah.
I would have guessed Micron because when I look at the top buyers in Micron, I am just amazed. Like over 50 million shares bought by these big funds, like Capital Research, which is a huge fund in California. It's like there's these two funds, Capital Research Global Investors and Capital World Investors. Together they manage like $750 billion. These two funds bought like, let's see, Capital World bought, oh my gosh, did they really buy that much? Yeah, 17.9 million and 4.6 million together. And then Wellington bought 8.6 million. Fidelity bought 6.8. It's almost like they look at Micron as, it's so cheap, right? It trades at, it was trading at 4 times earnings, right? Because that's what a chip stock can do.
Yeah.
When the cycle is
right.
maybe headed down.
Yeah.
And you probably called it a value trap yourself.
It is. It's still one.
So
sorry.
So they're piling in, and then
We're going to talk about it soon.
And then I look at the chart, and it's like, okay, yeah, it was down to $30 in late December. You could still bought it at 32 in early January, and it barely gets up to 45.
Yes.
And now it's back down to 35.
Right? Yeah, I was going to say.
Did these funds think, oh my gosh, we're buying another great low in Micron?
Yeah.
And now
they thought they were buying the bottom.
Yeah, and now it's already back. I mean, most of their positions have to be nearly underwater that they bought in Q1. Even though they were adding. Yeah.
Yeah. This is the danger with the semis, I feel.
The danger with, we sometimes we call the hedge funds the smart money, right? Because they have more research,
right?
More people, more tools, but they're not always the smartest.
Right. Well, we'll see.
Yeah.
We'll see how that turns out for them.
They can hold on a lot longer than we can.
Yeah. Although I did notice
it's not their money after all.
Right. But I did notice some stats from the first quarter and some prior quarters in general about hedge funds and the inflows and outflows. Mm-hmm. So hedge funds lost basically $88 billion in assets in 2018. So, and for the all 4 of those quarters, money flowed out of hedge funds, active management. And in the first quarter, outflows were again $17.8 billion. So it's still people, I don't know, a little bit dubious about how the active managers are performing here. A lot of them are struggling still, certainly on the value side, but even like there's been some struggles in the commodities sectors. That's been real difficult. And then I saw this little interesting tidbit that Sweden's oldest hedge fund was closing. It's closing this year, and it's been in business for 21 years. It's called Nektar, Nektar.
Oh, interesting.
Only had $1 billion under management, though, by the time it closed down. but it trades in interest rate and foreign exchange markets. And they said the tough conditions have just gotten too difficult, and it's just too tough. They're shutting down. But since inception in 1998, so these guys have been through a lot of different market conditions, they've averaged 9.1%.
Wow.
Yeah. It's pretty impressive,
and that's
I felt.
just in interest rates and currencies?
Yeah.
Okay.
Yeah. So Sweden's losing its oldest fund. I guess that's a pretty good run for a hedge fund, 21 years.
Right. And so should we close the show saying we're pretty sure the bull market's not over and to keep buying stocks? Or
Yeah, I don't think the bull market is over at all. Yeah, I don't know. We've gotten the boost off of those, to the December sell-off. Turns out for now that maybe was the buying opportunity to get some of your favorite stocks like Square a lot cheaper. But now we're going to hit the summer doldrums here, and we have the trade issues going on. So I don't know. What do you think we see in the next couple months here?
Yeah, well, you proposed we debate soon for our subscribers here whether you want to be invested in Chinese stocks. And to me, that sort of answers the question also about the bull market and the global economy.
Right.
If you're investing in Chinese stocks, you're probably pretty optimistic.
Very bullish. Yeah.
So
are you?
Yes, I am. Yeah.
Am I? Everyone should know the answer to this question. No. N-O.
So that's Tracy and I are going to have that debate for Zacks Ultimate subscribers next month. Last point. We mentioned a fund that closed, a famous manager, Steve Mandel of Lone Pine Capital.
Yes.
So I'm not sure what he's up to now, but I just Googled and I found a story about him from May 18th. This is the title of it. This is on geekwire.com. Secretive investment firm Lone Pine Capital is quietly minting tech unicorns in Seattle. So he may have closed his hedge fund.
He went like private.
Yeah,
maybe.
he's minting tech unicorns in Seattle apparently. So
okay. Are there still some? Can you still mint one? I don't know.
Yeah.
That's always good. It's good. Venture capital is needed, so why not these days? Okay. Well, we've covered a ton on this episode, and I'm going to run down a whole bunch of the tickers, give people a chance to go check these out on their own if they want to kind of follow along with what some of these, more famous active investors and managers are doing. So we had Alibaba, BABA, Micron is MU, Stamps.com is STMP, JD.com is JD, Pacific Gas is PCG, right? For that one, I always forget the.
And these aren't recommendations. We're just
putting out the tickers from the episode, everybody, so you can go look at them. Baidu is BIDU, Square is SQ, General Motors is GM. We had Chipotle, CMG, restaurant brands QSR. That's one of the weird ones. What else? Amazon, AMZN, because Buffett was buying that one.
You probably mentioned Alibaba, right?
Yes, we got the Bobs in there. Okay. So that's pretty much most of them. If we missed any, sorry, but you probably know what they are anyways. And as always, we will keep track of what's going on with all these managers because it is going to it's already interesting, but it's going to stay interesting probably for the rest of this year. And it'll be intriguing to see what they change in their holdings as we go forward over the summer. I know I'm going to be tuning in. So we'll be doing another one of these probably later in the year to check in again. So you don't want to miss a single episode of The Market Edge here. You can subscribe and get it every week. You can get us on Apple Podcast. We're on SoundCloud, of course, and we're now on Spotify. So a lot of places you can get us, but be sure to subscribe. And I'll be back again next week with some more stocks.